Hi, and welcome to the weekly market update from Morton Brown Family Wealth. I'm Dennis Morton here with Cody Demmel. Cody, how are you?
Good, how are you?
Good, thanks. Good, thanks.
Good.
So, week of September 28th, we're coming up into the month of October, the last few weeks of election season. Markets have been selling off a little bit recently. So we've seen things peak around the end of August, but really in the month of September, most stocks have been giving back some of their gains, and there's been more tension about really what the fourth quarter of this year is going to look like politically, pandemic perspective, everything else. So, Cody, any observations on what we're seeing in the market right now?
Yeah, like you said, we had a decent sell-off in September, especially in the high-growth tech companies. But I think that was kind of expected with the all-time highs we had, especially the really fast recovery we've had from the March bottoms. Giving up a 5 to 10% correction isn't crazy, and it's actually pretty normal and healthy for the environment to do that.
I agree, it's pretty healthy. But it is something when we start to see sell-offs like this, there's immediate talk of what are the alternatives? What can people do? Is there somewhere else? Okay, I can't get any yield from my bonds. If growth is slowing down in my stocks, isn't there something else I can do? So we found an article this week. It's actually a blog from Evergreen, which focused on how people sometimes move to illiquid investments. So they get out of publicly traded stocks and bonds and park their money someplace, trying to get higher income or higher growth. And it's a great write-up on that. Seems counterintuitive because if things are changing so fast, wouldn't you want to try and keep some flexibility so that you can change with the times instead of parking your money someplace where you can't touch it? But there's always that temptation. Cody, what did you take away from the article?
Yeah, I just thought it was a really interesting article, especially when they started diving into the investments from the late 90s to 2000 and how those companies have done till today. I mean, only a couple of them are around, and there's only one major winner. But we'll get into that in a little.
Yeah. So there's this whole idea of when you invest in private equity or private real estate, you're taking your money, you're investing it in a way where you can't touch it, you can't get money out, there's a lockup period, and the expectation is you're going to earn either higher income or higher growth in a trade-off for that illiquidity. But the challenge is you're picking one strategy, you're picking one methodology, and trying to pick when things are moving fast, when there's pace of change is moving so quickly, you can kind of be left behind sometimes. And real estate, we give the example of real estate. So a couple of years ago, owning a commercial property or an office complex might have made a lot of sense. Doesn't look so great right now. Things can change quickly, and it's hard to move out of that once you're in it. All right, so this is our version of a chart that Evergreen put up where we could give you a little bit more detail on this. So Cody, describe what we're looking at here.
We've tried to chart the 10 largest companies from 1999 to 2000, but like I said a little earlier, some of them are not around anymore. They've gone bankrupt. So we went with the next largest companies, and back in 2000, every single one of these companies had a market cap of above $200 billion. So now we only have two companies. We have Intel, which is only at $220 billion, so up around 10% over the past 20 years. Of course, Microsoft's done really well, but all the others are a lot lower than the market cap was back in 2000.
So the story was, if you're sitting in 1999, the internet and technology is going to change everything about how we live, work, and play. So if you buy the biggest companies that are playing in that space, you should be fine, right? Not true. 20 years later, we had one winner, 3 washes, 3 big disappointments, and 3 goose eggs, with Sun Micro, Lucent, and Nortel all going out of business. So you would have had about a 1.4% rate of return with dividends over that time. And the story was true. It was absolutely true. Technology did change our lives. But by buying the 10 biggest players in that space, you would have missed Apple, you would have missed Amazon, you would have missed any number of players. So think about where we are today and saying, how willing am I to go all in on the narrative of the future by giving up flexibility in the near term?
Yep, exactly.
And again, the conclusion of the article was that if you're giving up liquidity for income, usually that means that you're doing it via leverage. Somebody's taking on debt to pay you out more, and that's a risky proposition because a stiff breeze for an embedded enterprise, a stiff breeze can blow it over, and that's not good. Mm-hmm. And we said the better plan is to try and find growth. Try and find that next entrepreneur, that next Jeff Bezos, that next Elon Musk, and find them. Or you could end up with the guy from Nikola.
Yeah, that would not have gone well for you, unfortunately.
No. So I mean, these companies, sometimes they turn out to be they don't materialize. Sometimes they turn out to be frauds. Sometimes it just doesn't work out. So it's a tricky proposition. Liquidity has a premium, so keep that flexibility. All right. So anybody getting married anytime soon? So we were talking a little bit about conversations about money in marriage recently. So I mean, we work with a lot of couples. There's a family dynamic. There's a money dynamic. It's always very interesting. We learn so much from the conversations that couples have about money. And I was thinking about a blog that I wrote last year about my experience with my wife when we first met, and how she thought I was broke until the night we were engaged. So she kept seeing me using a card to pay for everything. And in her mind, she thought, oh my gosh, this guy's loading up credit card debt, and I'm debt averse. I really don't like it. So she just held that in. And then the night we were engaged, she sat down and said, all right, we need to talk about finances because I'm worried about your debt levels. And I pulled out the card, and it was a debit card. I said, I don't know that. This is a debit card for everything. Oh, I had no idea. So, that started our conversations about money. Cody, what kinds of things do you guys talk? What have you learned in your kind of engagement experience in talking about money with your fiance?
Luckily, she knew that I was a financial advisor coming into a relationship, so it was a little different of a circumstance compared to that people that have different careers. So I mean that was definitely helpful in that aspect. But I just think it's really important to make sure you understand how your partner feels about money, whether they like to spend it more, whether they want to save more. I think that's probably what we've learned the most about each other's views on money going forward, just how we actually look at it.
Right. Because even people who are carefree about money can be stressful on the other partner. Like if the other partner is very high tension and worried about spending or worried about debt, a carefree person who's just, it doesn't bother them, that can be a source of tension with our spouses, with a lot of baggage from how we were raised or job experiences, everything else. I think the more you put that out on the table, the better off you are in the long term. Another thing about couples, especially as you work with an advisor, so people who come to us, some of the best relationships we've had have always been where both couples are engaged with the advisor. Sometimes, not to be stereotypical, but it's the husband's golfing buddy who happens to be the advisor. He's the only one that communicates, and their spouse is not necessarily involved in that conversation. That can be a challenge because God forbid something happen, or we get down to things like retirement planning or big picture planning, and the learning curve for one member of the parties is really steep. That can be a challenge. Yeah. Where did you get engaged? Where did you pop the question?
In Washington D.C., right by the reflection pool by the Lincoln Memorial.
Nice. What season?
Spring. There were a couple cherry blossoms. It was nice.
Very good. How were the anxiety levels that day?
Not good. They were at probably all-time highs.
As he says, in a pandemic year. That's
yeah.
Good. Yeah, I proposed in a back room of a haunted Mexican restaurant in Las Cruces, New Mexico. So I just remember walking in and telling the waitress as I walked in, just saying, "Hey, listen, I'm going to be doing this. Can you give me a few minutes of privacy?" And so I walk into the door. My wife's soon-to-be fiance is in there. Close the door, and hear someone shout from outside, "Don't go in there for 10 minutes." So she, it was just a matter of time. But yeah, but high nerves that day too.
Oh yeah.
It had nothing to do with the haunted room. All right. Well, as we head into fall, wish everyone a great season. Hope you and your families are all well. Let us know if we can answer any particular questions. We know there's a lot of things that are creating anxiety and stress, whether they're in kind of interfamily communications or just stuff that's happening in the world out there. So if there's a topic you'd like to hear us cover or something you want to reach out and speak to us directly, feel free to do so anytime. And we look forward to catching up with you soon.